Good day, everyone. This is Dr. Sivaraman of iknowindustries.com. It is the second webinar for me today, and in commemoration of the 10th anniversary of FX Trade, I am giving the webinar series, My Trading System. I already covered about 5 webinars till yesterday, and the 6th webinar I am going to take up the topic, types of market moves and the trades. So in the earlier webinars, I have been explaining what are the limitations and the constraints one could face one has decided to enter into that of the trading. So like any other art, suppose you want to learn how to drive a car. Obviously, you need to know the mechanism of the car and what are the risks involved and what are the pedals you have to press and how exactly you have to alternatively use it and how you have to develop the road sense and the control over the steering. So every part is important. So step by step, you have to learn everything. Then finally, you have to coordinate all and try to drive the car. So that is how you develop an art. So in the same way, I have given the 5 webinars explaining the various the constraints or what are the limitations one could face and what could we face so that we should be prepared for it. So once we understand, okay, these are all the limitations, okay, these are all the problems I might face. So what are the contingency plans I have and how exactly I am going to read the market? Then how exactly I am going to decide on my trades? Once you develop these ideas, then it becomes easier for you to maneuver the market, understand the market and try to trade at ease. So I will gradually take you through this particular process because you will not be able to achieve anything what you aimed it as a goal, but you have to undergo the process and you have to understand what are the steps you have to climb in order to achieve that particular perfection. So that is why I am giving it in stages. So today I will be talking about the type of market moves. So I explained yesterday with regard to the market reading. In that market reading, what I want to derive is identify the false move. So how exactly one can identify the false move so that we'll be able to really give what could be the next intentional move. So first of all, we have to identify or understand what are the type of moves the players make in the market. So you should be able to define them in terms of pips, in terms of time frame they take it. So if you simply take it in terms of pips, then you may not be able to really understand when exactly they are going to do it. But if you understand in relation to that of the time they are taking for a specific move, then you will find that you can really recognize such moves much in advance. So you have to theoretically learn the type of moves the players could make in the market. The first type of move is stop and. Because in an earning process, the stop and is the most frequently used type of move. So it happens in less than 30 minutes. So probably they can take about 10 to 15 minutes and finish up, or they may take up to 30 minutes and finish up. Then today I was explaining during the Asian session live market analysis that they made an initial cut in the case of GBP. Probably I'll just show the slide and explain to you. So these are all the initial lows and the highs. In the case of GBP, the initial high was 1.5594 and they made a breach above that and went up to 1.5624. It was a typical stop and. So they made a typical stop and come below that of 1.5594 in less than 30 minutes. So you find either during the start of the session or during the end of the session, they make this sort of move. And it takes less than 30 minutes time frame. Similarly, in the case of Euro, the initial high was 1.3006 and went up to 1.3041 and came down. So you can understand that either before that of the data release time or during the start of the session, they could apply this particular thing as a false move. So In the case of CHF also, the initial low was 1.0599 today, and they breached the low and formed a new low 1.0575. Earlier it was about 1.0581, then went up to 1.0622, and they did not breach this particular high and came down and hit the low. What is that referred to? Okay, I'll go to that of the next type of move, the false move. So it is also a move which takes about less than 30 minutes. So both the type of moves, stop-ins and false moves, are taking less than 30 minutes. But they move up to that of the high or the low and then reverse and immediately hit the opposite side. So from that of the low, they went up to that of the high in the case of CHF, but they did not breach the high and came down and hit the low and gone below. Now it is staying below that. And during the Asian session webinar, I explained that they wanted to drop Euro CHF cross, or that they wanted to drop CHF. So we were able to read their intentions from there. Similarly, in the case of Euro and GBP, they made an upward stop-in which took less than 30 minutes, about 20 to 30 foot move above that of the initial high and came back below that of the initial high. So this is how the stop-in is being made. They know very clearly that above that of the high, there will be cluster of stops. They can hit the stops and then come down below that and start going downward or swing around, and towards the close of the session they may make another stop-in and come down. So stop-ins are normally used during the start of the session and end of the session, and sometimes it may be a false move also, like what they have done it in CHF. So you have to, in whatever the currency you are interested, or look in all currencies, make a note of the initial lows and the highs which are set between 0030 GMT up to 330 GMT. But normally they finalize the initial highs and the lows between 230 and 330 GMT. Then from there you see how exactly they start making the moves. Are they making a stop-in? Then when they are making an upward stop-in and just gone above that of the high and come below that of the initial high and stay there, then you try to take a sell position. Or if you have become well versed, then during the stop-in, in about 10 minutes, they will stop cutting the high, but they will simply hold near that of the high, new high, and understand they are not cut the new high. So take a sell position. You will find within that end of 30 minutes, they will go below that of the initial high, then try to get stop at entry. So you should be able to identify, are they doing the stop-in or a false move? These two types of moves are happening in less than 30 minutes. Then sometimes before the data release, they make a false move like this. From that of the high, there could be a spread of about 50-60 pips between the high and the low. They can quickly come from that of the high up to that of the low without cutting the low. And probably on Monday they did it, and they came down exactly to that of the low and then reversed within about 5 minutes and came up to that of the high and cut the high and stayed above there. When the data was released, immediately they went up. So they make a false move before the data release time, and also they make a false move during the gap times. I explained the gap times before that of the Japanese session, before European session, as well as before US session. So those gap times, they could make a false move. During the gap time, if they rise Euro up to that of the high, understand during the first 30 minutes of the session, they are going to drop. And if they drop during the gap time, understand first 30 minutes of the session, they are going to rise. So 30 minutes and 30 minutes, you will be able to finish the trade in 1 hour time. Then you come across another type of move, namely swings. Without cutting the high or the low, they try to make the market to come from that of the high up to that low and go above, or up to that of the middle level and then go above. So this you come across normally during the consolidation. Now they are doing higher level consolidation. I'll explain to you with the help of the slide how exactly you can identify that. Then, so swing moves are between the high and the low without breaching the high or without breaching the low. That is referred as a swing. The swing spread, say for example in the case of euro, you come across the spread from 1.2967 to 1.3041, so about 100 pips. In the case of GBP also, you come across similar pips. So that sort of swings they can do, or from that of the high to that of the middle level, and again try to reach up to that high, but they don't breach the level. And now, exactly by 12:30 GMT, you know that there was a data release, and for that everybody was expecting what could be the outcome of the data, durable goods, and what could be the possible move. Before the data, they quickly made a dip in the case of euro and GBP. Then after the data, they simply formed up. But it is not a very significant move as such. It is only about 15 to 20 pips up and down move. They have done it because they have got a purpose now of holding high and testing the patience of the traders. Then you come across the next type of move, namely extended move. This sort of extended move takes more than 30 minutes and the move remains till 2 hours. So suppose if they make the extended move after the data release around 8:30 GMT, then up to 10:30 GMT, they will be cutting the high going higher, cutting the high going higher, like that. And for about every 30 minutes, they will cut the new high and go above, cut the new high and go above. So there the limitation is the net permissible level, about 150 pips in the case of euro or about 250 pips in the case of GBP. That sort of move they will be making it, and that will be very quick rise, or opposite. They can make an extended move on the downside also, about 100 to 150 pips. So when they make a very quick move of this nature above that of the high, don't try to take immediately some sell positions and things like that. Wait for 2 hours. Then see that in the last 30 minutes of our observation, suppose if they start by 8:30, then up to 10:30 you wait. In your last observation of between 10 and 10:30 GMT or 10 and 10:30 hours, the last 30 minutes, if they are not breached the high, then you try to take a sell position, you will be able to get a swing trade opportunity. And similarly, during the drop, if you buy, you will be able to get a swing trade opportunity. So they will try to make the move from that of the new high up to that of the earlier high, the second high, or up to that of the first high, what they have formed, and then just go back. What they do is on the higher side, a pump and dump move. On the lower side, they make a dump and pump move. So what is that referred to? They continue to hold the levels and try to distribute the positions. And whenever the buy orders are there, quickly they remove their buy orders and sell to that of the other traders' buy orders, and quickly place a higher level buy order and make the market appear it is simply holding. And if you keep the orders in your trading platform, you will come across that your orders will get filled, but you would not have seen any sort of dip at that time. So that is how they make a very quick move in the market in order to hold at a higher level and book profit of their lower level buys. Similarly, they induce the traders to liquidate their long position at a lower level and they try to buy it. And that they will do it by making an extended move. So the extended move is also normally called as spike. So whenever you come across a very quick move on the upside or above that of the initial high or on the downside below that of the initial low, understand that they are making an extended move. How you will be able to confirm the extended move? Differentiate it from that of the stop hunt. In the case of stop hunt, they will just go above that of the high and come below that of the initial high in less than 30 minutes. Whereas in an extended move, they go above that of the high and they don't return back below that of the initial high even after 30 minutes. And so you understand they are making that extended move. So if you realize the time what they are taking, then you will be able to differentiate the stop and move from that of the extended move. Whenever there is an extended move, then if you have a lower level buy position, don't be in a hurry to book profit. Why they are making 3 such moves on the upside? The first move will be their circular trade. So they quickly put their higher level sells and buy it by themselves, then automatically the market goes up. In the first pullback, whenever a surprise comes, immediately the short sellers come for short covering. So they try to distribute the short sellers. At the same time, some of the traders, those who have got the lower level buys, will also try to book profit. So they will simply induce the short sellers to cover it from them or buy it from them and try to keep a lower level buy order and try to see that anybody is booking profit which is being absorbed in the market. The spread might be about 20-30 pips. Then immediately they will make one more upward spike in 30 minutes time. At that time, the trader who has just liquidated the long thinks that, oh, in a hurry I just liquidated it, let me buy it. Then they will try to do it. And similarly, a person who has done the short covering will try to buy it. And they try to hold it in such a way in the second one. The third one, there will be a lot of traders who will try to sell. So they will make a very quick upward stop and just hover around, and afterwards they don't cut the high. So that anybody who has taken the buy position at a higher level thinks that, okay, the going is good, so I'm not making big money, but I am very sure Euro is going to rise it to 1.32, JBB is going to rise it to 1.57, so let me calmly wait. That is how they will do it without any preparation of how to limit the risk. Then you find that on that particular day, they would have just made a little bit of upward stop towards the close or something like that and hold the market. Very next day, they will try to make an intentional move. And the intentional move will be just opposite of the extended move. After the extended move, whatever the buy positions their players have accumulated at the lower level, when they are offloaded to that of the traders, there is no point in rising the market. They will simply allow the market to just drop without giving a support. Then when the market slowly slide for about 2 to 3 sessions on the next day, you will find at the end of the third session or the second session, already about 150 pips is lost. So those who have taken the higher level buy or a breakout trade, if they are not taken any of the adequate measure to limit the risk, you'll see that holding it just like that, the higher level buy, is not a good strategy. Then they will try to liquidate their long position. So intentional move is a slow move, and it will be a slow process without a pullback. So they will slowly slide about 50-60 pips during the first session, again another 40-50 pips on the second session. Then finally during the year session, a very quick drop and then probably a recovery move. Why? Because after the third drop, the traders will think that, okay, the support is breached, the market has gone below that of the support. Obviously, support is going to turn into a resistance. So let me take a sell there. Then at the end, the players will gain the levels and induce them to do the short covering. So this is what you come across. This sort of intentional moves and the extended moves are normally seen when the volumes are built up in the market. If in a thin volume condition, you do not come across these moves, and probably they can make a false move, a quick move, and just hold the level in order to induce their traders for the week beginning. So false moves intraday, they make it during that of the gap time and also before the data release time. Then the extended moves and the intentional moves, whenever the volume is built up, then they go in for, or whenever they are adequately distributed their buy position at a higher level, then they will go in for an intentional move. Or whenever they are just sold it at a higher level and they want to buy it back at a lower level, then they will make a downward extended move and to keep at a lower level a consolidation and try to buy it when the traders sell it in distress or when the traders liquidate their long position. So quick moves are false moves in the market. Slow moves are the intentional moves. You can identify that. And intraday, if they are making slow moves between high and low, is want of volume. But above that of the high or below that of the low, when they are making such moves, when it is a quick move, then understand they want to quickly gain the levels without accumulating more buy position at a higher level. That is why they make a quick rise by doing a circular trade, so that anybody who wanted to sell will think that, okay, the market is quickly galloping, so why should I sell it at a lower level? So let me wait for it. So probably a sell and buy trade could be a wrong trade. That is how they will keep away. When they make a quick move, then immediately it gives a surprise or a stunning effect for that of the traders, and they avoid selling when really that is a good trading opportunity. So that is how they trigger the emotions of the traders and see that they are able to successfully earn money from the market. But they will only induce the traders to go in for a distressed trade. That might be permitted, and there are a lot of people who know that whenever such quick moves happen, the platform frees, so you will not be able to sell. Whereas if you keep a stop, that will be definitely filled. Whereas at the same level, if you keep a limit sell order, it will not be filled. So the importance of tracking time of the market. I have given you the session's timing. So the session start and the session end time, and mid sessions they handle the crosses. So in those time frames, if you try to watch how exactly these moves are being made, you will be able to really understand, okay, after this extended move, the next day they are going to make the intentional move. Session start time and the session close time, they can make stop runs. During gap time, they may make either a stop in case if there are plenty of stops above or below. Otherwise, they will normally make false move. Before the data release, also they will make a false move. And a swing whenever the volume is less or whenever they are handling the crosses, probably holding euro and dropping GBP, or just holding euro and rising GBP. This sort of swings will be there, and during such swings, they will not breach either the high or the low. If you identify, you can do the swing trade during the mid session. When euro comes closer to the high and not breached for more than 30 minutes, you can take a sell. During the slide, you can simply book 30-40 pips profit. So you have to identify the type of moves, then you can easily identify what sort of trades we can do in this particular market. Then afterwards, how exactly we can identify them in terms of pips. So I forgot to explain one more move, namely extended stop. This is the type of move which can happen for 30 minutes to 1 hour, and it will be for that of the entire permitted or the limitation given. So they can quickly rise euro for about 150 pips and reverse within 30 minutes or 1 hour. Just telling that there was a rumor and it has been confirmed it was only a rumor, but they would have hit all the stops and go opposite very quickly. So this they use it during that of the monthly trend reversal time, and this sort of extended stop and they make occasionally so that it can really create the fear, and it may look like an extended move, a quick move, but in an extended move, say for example euro is staying around 1.28, they make an extended move up to that of 1.2950 and they don't drop afterwards. They swing around that 1.2900 to 1.2950 area, and that is how they hold it. The next day they may drop it. Whereas in the case of extended stop, they from 1.28 they go all the way to 1.2950 and come back to that of 1.28 in a matter of 30 minutes to 1 hour. Similarly, on the downside, if they are around 1.28, then they go down all the way to that of 1.2650 and then come back to that of 1.29. You would have seen when GBP was galloping above that of 1.52, they have been making a range bound moves between 1.52 to 1.51 area, and suddenly they came down, 1.52 to 1.50 area. Suddenly they made an extended downward stop into 1.49 and reversed within a matter of 1 hour and then gone up to 1.53. So this is how when they are shifting the trading zone, they try to make this extended stop. So you have to identify whenever there is an extended stop, and you should not become stunned or just lose the confidence in trading in the market. The going is not good. That's how you should not think. But they always try to take a last chance of hitting all the stops before making their intentional move. So that anybody who has taken during that consolidation, any buy position, they kept stop, and obviously the stop will be filled before making a rise, so that the trader will not be able to really capitalize the market or take advantage of the market. So we have to identify what, in terms of it, how the moves are being done. So firm up or a slide, just opposite of this. Firm up about 30 to 60 pips on the upside or slide 30 to 60 pips on the downside. A rise or a drop from 70 to 100 pips on the upside, a drop 70 to 100 pips on the downside. A quick rise or a quick drop, about 110 to 150 pips on the upside. Quick drop is 150 pips on the downside. Sometimes more, or in the case of GBP, they can do up to 250 pips. So we have to understand the limitations. I explained how exactly the limitations can be read. I also given the levels or what are the type of limitations you come across in different currency pairs. Then the upward spike and the downward spike, they try to do it as an extended move with a fully permitted levels, about 150 pips in the case of Euro or 250 pips in the case of GBP. Up to that they can do it. Either if you see the net change of 250 pips or you see that 2 hours are over, then you can identify that the extended move is over. So suppose the first move is only about 30 pips in the extended upward move, then they can make 3 times the extended upward move and it can go up to 90 pips. Then suppose the first move itself is 40 pips, they can go up to 120 pips on the net change. The first gain is about 50 pips. Understand they can gain up to 150 pips 3 times. They will cut the high, new high and go up. So when you look into that on the net change level, you'll be able to easily identify, okay, the extended move is over. Now they are going to distribute. So any firming up move, I'll try to liquidate and they will do the pump and dump move. So when they dump, the market will come down. I'll just sell and take a buy there. And again wait for the pump and dump move, sell and again book profit. This sort of trade we can do it. So we have to identify the type of moves so that they will not make an upward stop and afterwards. Then you try to take positions at that time. You will be very, very safe. Then you come across another important thing, namely the follow-up move. The follow-up moves are for the week or for the month and things like that. Suppose they gain the levels in the case of Euro and GBP, for example. From last week, they gained up to that of 1.30 in the case of Euro and up to 1.55 in the case of GBP. From there, do you come across a follow-up move? They hardly gain to 1.56 in the case of GBP and they are hovering around 1.29 to 1.30 level in the case of GBP. So the follow-up move is lacking. In the next session or in the next day, then what is that? We have to identify that they are making consolidation. So I'll explain with regard to the consolidation in the using the next slide. So you come across the trend reversals are happening in the market either as an intraday trend reversal or a long-term trend reversal. So they use the stop-ins or during that of the intraday. I use false move for the intraday trend reversal. So they make an upward stop-in and then drop, then a downward stop-in and rise. So they only use the up and downward stop-in or a false move for intraday trend reversals. So extended stop-in or intentional move, they do it when the volume picks up in that particular week. Probably they try to use it or they try to make such moves whenever a data release is there, which is of prime importance. If it happens on a Monday or Tuesday, they don't make any big move. And if it happens on Wednesday, Thursday, Friday, when a lot of traders start holding unfavorable positions, they try to make such moves. Then you have to keep in mind that always the market may appear they are making similar moves, but they don't do hat trick. So that is how they will make the chart appear as if they are following a particular trend. Okay, they get a small stop and then subsequently a rise during the start of the European session. And say for example, yesterday during the early European session, they made a quick downward move in the case of GBP and then firmed up. And today also they made a quick downward move and firmed up. And tomorrow if you see that they will make a downward move and don't firm up. So they don't do any hat trick. So they don't make hat-trick moves, or hat-trick is in the sense three times it should occur in a similar fashion. But they do it two times. The third time, they make it as if it is going to be a similar move, but quickly reverse. Only then they can give surprise to the traders. So not more than two concurrent moves will be similar. And in the case of hat-trick, you find that the market is of a 24-hour nature. So there are three sessions in a day. So suppose if they are dropped during that of the Japanese session, again dropped during that of the European session, understand US session, they are going to form up. They may make a quick downward move during the start of the European session, but they will not continue to drop. You will come across, they will invariably rise unless and otherwise there is a shift in trading zone. I will explain to you it with the help of the next one. So we have to identify that they don't do hat trick, and whenever you find the third time they do it, it is a false move. So you are able to identify the false move during different occasions. So they don't make similar moves of 2 sessions, 2 days, 2 weeks, 2 months, 2 years, and similar moves. So if they made a quick downward move in the case of euro for 1 year, the second year they may drop, third year definitely they will make a rise. So this is how we should be able to identify the yearly moves of the market. But if you are an intraday trader, try to focus on the intraday hat-trick rules. Then session-wise intraday, weekly, monthly, and yearly trend reversals are there. Trend reversal in the sense what? They have been slowly dropping it and suddenly reversed and started rising. That is trend reversal. A U-turn happens in the market, and that is trend reversal. And downward U-turn or upward U-turn. So on a daily basis, if you look into the chart, you will be knowing, you will be coming across U-turn on the upside or the downside alternatively. And similarly in the week also, first 2 days they might make a drop, and third day they will make a little bit of volatile moves, then fourth and the fifth day they will start gaining the levels. So that is how they make the moves, because the weekly permitted limit is such. Say in the case of euro, is about 150 pips on a daily basis, about 350 pips on a weekly basis. So if they rise 150 pips today and tomorrow another 150 pips, 300 pips is over for the week. Third day they can gain only 50 pips. Afterwards they have to continue to hold there or make swings around that. So they have got a limitations. Obviously they do that way. So they don't concurrently make the follow-up move. Then similarly with regard to the month, there are limitations. So accordingly they make the moves. So we can really identify the intraday trend reversals by looking into that of the type of stop loss they are doing it, either on the upside or on the downside. So differentiate whether the move is quick move or slow move, then you'll be able to differentiate whether it is a false move or a true move. Slow moves are true moves and the quick moves are false moves. Then you find the unidirectional move. Sometimes you come across you find in the case of the denominator currencies especially, they make similar moves for 3 days. Drop, 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 drop in the case of yen or CHF for 3 days. And then subsequently hold there and accumulate. Then rise for 3 days or 4 days. So you come across the unidirectional move in the case of the denominator currencies, but not in the numerator currencies where the volume is high. And especially in the case of crosses also, they do this sort of unidirectional moves. You have to identify whenever you take a buy position which is not making profit in 1 day, you have to wait for 3 days before making any average. So that there will be a drop of 500 to 600 pips. Then afterwards, if you average, when they pull back, you will be able to close both the positions above their net average level. Then you also come across the week beginning false move, month end and new month beginning false moves, then year end and year beginning false moves. So you have to identify. Suddenly you will find that there could be an euphoric condition, euro and GBP in the first 15 days of January. They would have just gained the levels quickly as if nobody will be able to buy it. But later on you will find that it is only a gimmick, and afterwards they start dropping it in a big way. So they always create some sort of sentiment in the market and act against it, and that is how you identify the trend reversals. And the short-term and the long-term trades, how exactly one can take a decision on that. So decision making while trading I'll explain in detail more in the next webinar with regard to the trading. But basically, it is not enough if you try to decide with regard to the entry alone. You have to think of also the exit from the stop or the entry stop. And you have to determine the risk. Okay, how much of risk I'll be able to take it. And is it possible for me to minimize the risk to nil by keeping stop at entry? And this is how you have to take decisions with regard to trading. I explained to you with regard to the market moves. Whenever you identify the market move, okay, after the false move, they are going to make an extended move. I'm trying to take a buy and sell trade. Okay, still, my reading might be wrong. So let me use the stop or the hedging order to limit the risk. Once the position makes profit, I'll keep stop at entry. So that if they hit it also no problem. I will be able to re-enter the market. Market will continue to give trading opportunities. Then minimize the risk and maximize the reward by converting that stop into a trailing stop and keep a limit, an optimal limit. You determine that exit level and try to exit out of that. Don't become greedy when the going is good and don't miss that opportunity. Then within the day, aim for about 30 pips if you are an optimal swing trader. Otherwise, you can just make it as an intraday profit of about 100 to 150 pips. And because that is a daily limitation. Beyond that, you will not be able to take it. Otherwise, you close the position next day when then an opportunity comes. You can just do the second trade. There is no harm in entering and exiting out of the market. And don't be possessive of your positions. Then there are different types of trades you come across among the traders. The scalpers, the scalping trade aiming about 5 to 10 pips, and that will be a really impulsive trading. And if you check with any of the scalpers, how is the going? They will say, I am doing it. In some trades I am making profit, some trades I am making losses. At the end of the day, you will find that they are where they have started. Then swing trades aiming about 30 to 50 pips. So I don't encourage people, small traders going for a scalping trade, and it will make you really jittery without understanding the concepts of the market. Then swing trade aiming for about 30 to 50 pips, which is an ideal swing trade. Whenever there is a data release, don't worry. Before that, they will not either make a spike on the upside or the downside. You will have a great swing trade opportunity. You can just finish up your trade before the data release, so that you will have an optimal swing of 30-40 pips in the market and you can book profit. Sell near the high or buy near the low, you'll be able to definitely book profit. Then session-wise trade, aiming for about 20 to 60 pips. Suppose session start, the market is near that of the high, not breach the high, you try to take a sell. Before the end of the session, you try to close it. Then next session, you try to buy it near the low and close it near the high. And you will come across the intra-day trend reversal between sessions, so you'll be able to capture the profit. Then technical trade is whenever they cut the high and stay above that of the high, you try to take a buy position above that of the high. Then try to aim for a upward spike profit, because the extended move is going to be there. Once they cut the high and stay above there for more than 30 minutes, then an extended upward move will be seen. Then you can book profit of 50 to 75 or whatever the left out net change will come across. Already they have gained about 70 pips. The maximum they can rise is only 80 pips from there. Then identify that limit and try to take positions. Then intraday trading can be for about 75 to 150 pips if you are watching all through the day, right from the start of the Japanese session till your session. And that is possible. There is no need to watch the market all the time. And you take the position once you are comfortable enough in keeping the stop at entry, then you can go to bed and you can come and see where exactly the market is and come back and see whether you are able to book profit of 100 pips or 150 pips. So that's another important thing many people fail to understand is the shift in trading zone. So they don't make the consolidation in a range all the time. In the case of Euro, they made a high level consolidation around 1.435 level, and they have been making a high level consolidation with a frequent upward stop. That indicated that they are going to shift it to the middle level. So middle level, they made it around 1.27 area, and that was the middle level consolidation. And that you find they have shifted the trading zone and they don't revisit that higher level consolidation level afterwards. So the spread between that higher level consolidation and the lower middle level consolidation will be minimum of 600 to 700 pips. Then they consider the either way stop. How you can identify these consolidations? Higher level consolidation, they will try to make upward stop point. They will make upward stop point here. They will make an upward stop point frequently, but no downward stop point. Not much of a downward stop point, much of an upward stop point. Now you come across more frequent of an upward stop point. You can understand where they are now handling the market. And with one quick extended upward stop point, they will drop the market and come to that of the middle level. Then in a range of 300 to 500 pips, they will make the middle level consolidation, and at that time they will make either way stop point. So they will make the stop point on the downside, make the stop point on the downside as well as the upside. So either way stop points when they make on a daily basis, understand that it was a move to that of either to that of the lower level, again going back to that of the higher. So they can just come to that middle level, again go back. Or they can push it down if the traders are holding long positions and not willing to liquidate. Then they will try to shift the trading zone to still lower level and make a lower level consolidation. How you can identify the lower level consolidation? They will make frequent downward stop points. So lower level consolidation with a frequent downward stop and indicate that that is a low level. So finally, one extended downward stop point, like in the case of euro, they came down all the way to 1.1877, then pushed it up to that of the middle level straight. So an extended stop point and then upward shift in trading zone, and after coming here, quickly go to that of the higher level consolidation. And invariably, everybody will be bearish here when that extended downward stop point is made, and nobody will be willing to take a buy position there. And everybody will say that it is a falling knife. But they quickly reverse and take the market up because they buy up to the last level and then quickly gain the levels. Why they quickly gain the levels? To book profit. They are at their job. Then after doing the high level consolidation, they will again, after the season, they will come back. So this is how they make the market cycle. So you can identify whether currently the market is in the higher level consolidation or the middle level consolidation or lower level consolidation by identifying the stop points they make. If they are making frequent upward stop points, like what you are seeing now, okay, they are doing higher level consolidation with an upward stop point. They are discouraging traders doing sell and buy trade. That is what it refers to. Then afterwards they intend to drop. Hope you are able to understand. So if you want to do a position trade as a long-term trade, the type of trade, so initially you think of a swing trade only. Don't say that I will simply take a position, I will close it after a month. That is not position trade. You try to identify a strategic level during that sort of extended stop, then take a position there with its stop at entry. Then frequently when the is good, you try to hold the position for a long time using a trailing stop of 75 pips away from the market. It's important you are deciding on the type of trade. Simply holding about $500 as equity and say that I am doing position trade, and your equity may not be able to withstand the type of moves the players are making in the market. So understand, if they are doing a shift in trading zone, you are caught on the wrong side. They can go all the way down by 1000 pips, all the way go up by 1000 pips. If your usable margin is not in a position to hold, then don't say that I am trying to trade position trade. That means you are cheating yourself. You have to understand the limitations, what you can do, because the market spread is so high and it can make about 2000 to 3000 pips in one go over a period of time on the upside or on the downside. So whether you have got the capacity to hold it, you have to understand. Otherwise, use necessarily a stop or a hedging out if you limit the risk. So always try to take one lot position. If you have more than $30,000, you try to take one standard lot. If you have got less than $30,000, you take one mini lot position and take a very minimal risk and try to maximize the profit out of that. We are here not to take a risk. It is not, it does, if you are taking a big risk, it doesn't mean that you are a brave person in the world. No, you are a loser. That's what. So you have to identify how smart you are rather than I have a capacity to hold the position for about 1000 pips drop. That is a very wrong attitude. Then why do you take the position and wait for 1000 pips loss to happen? Later on, you try to do a crisis match. You limit the risk. And that is very, very important. Whatever be the type of forecast, you try to use it. And still, every forecast has got a limitation. Understand that. So the trading strategy, you have to necessarily use it in order to limit the risk. Then the weekly trade, take very less position and aim for the profit using the weekly spread of the market. Use the hedging. Then if the market goes on the upside, try to book profit. If the market goes on the downside, try to book profit on the hedging. That way trade also you can do it, but you need to understand that. Simply you cannot try it out. Try it in a demo trading platform and see how exactly you will be able to handle such situations. Then you can probably think of such trades. Then the position trade, following monthly trends, aiming about 350 to 900 pips. Whenever the extended stop and happens, you try to take a position, you can really make money out of that. But at that time, you find the greatest fear will be in the minds of the traders. So that is why in the blog I used to give it, wait for the extended stop and then try to take the position, either on the downside or on the upside. So if you try to take the position within about 10 minutes, you will find the position is making profit and you can keep stop at entry. They will not revisit that level at all. So you know that GBP, they came down all the 1.40 or 1.41 and quickly reversed it. So you have to really understand that sort of quick moves are false moves. And they will do it during the start of the session simply to create the surprise to that of the traders as soon as they open the trading platform or a live market code page. Why they do that? So that when they drop, there won't be any buy limit order up to that level. They know very well they can do a simple circular trade and drop and hit only the stops or attract margin calls to that of the traders, those who have taken more positions and quickly reverse it. So I'll go to the last slide. Before that, I'll take up the questions which are asked here. I'll focus the camera over that of the live market code page so that you will not say that the camera is black. Okay, max. Where do you see S&P 500? Okay, now I'm not going to discuss any forecast here. Please ask the questions in the blog. Any question pertinent to what I explained, I'll definitely give it, please. For permitted levels, you set some terms. Can you use it? That is the limitation. That is daily permitted levels or weekly permitted levels, like 150 pips in the case of Euro and 250 pips in the case of GBP. I have given it in the earlier webinar. Kindly go through that. You'll be able to see the levels there. Then, any chance players will change their tactics. See, I've been watching it from 1996, the market, and done the back testing very periodically, and I find that they are using the same techniques. See, probably you know that in 1990s and 2000 years, the last decades and this decade, do you find any variations with regard to the cunning strategies of the pickpocketers and things like that, culprits? They use the same tactics. They try to deceive you and then try to grab your purse. Same they will do at every time. Probably slight variations might be there, but other than that, they cannot do anything. They have to first of all deceive you, and they have to first of all control your emotions, so that you are not able to use your reasoning ability. Then they will be able to grab your money. Can we say players or crew? No, they are smart fellows. They wanted to earn money very quickly. They are the richest of the richest in the world, and they want to see that money multiplies further. I do not know whether they will be able to eat gold, but the level of greed is such, like Midas. So what else we can say? So they try to deploy the money in various markets and try to earn it. And So we should not worry about the players, but we should try to read their intentions. I think that is the best optimistic approach to this. Then delete. This 150 pips limit application for all pairs except GBP. Is that right? No, I have given it in this last webinar. Please read it. 150 pips in the case of Euro, 250 pips in the case of GBP, 200 pips in other currencies, Australian dollar 100 pips. And AB. Is PDF of the presentation available? Is it nice? You have the webinars are being recorded and the entire slide is also displayed there. You please go through that. And there are so many displays. The recorded webinars are readily available in my blog page, Market Reading. I frequently update where the links are. Also in FX Trade Archives page, you come across the links for the blogs, links for the webinars I have given it. You can go through that, please. And see, you have to do a little bit of homework and you have to go through the archives and see anybody who has given the forecast or any market study and things like that. After about 15 days, you just listen to that again. Then you will be able to understand the sense of it. Otherwise, you simply listen it today and afterwards you look into your position, then you will be simply focusing on your positions without undergoing the learning. And if you don't undergo the learning, and your expressions will be erratic. And if you are really molded, then your expressions towards the market will be fine-tuned and you will see that you are able to control your emotions. And you will not lose your thinking ability during the market times. Then for position trades, what do you mean by monthly trends? Do we look for a monthly chart? Now you can look for the monthly charts. Whenever I give an explanation, whenever you come across a quick extended downward stoppant or an upward stoppant, I defined a downward stoppant or downward extended stoppant or an upward extended stoppant. It happens for about 30 minutes to 1 hour only, not throughout the day. They quickly drop the market as if the world is going to end. Then subsequently, within about 30 minutes, you will find all the way they gain the level back. That is extended stoppant. So you have to discriminate the extended stoppant with that of the extended move. Extended move, either they drop quickly or rise quickly, afterwards they don't reverse it. Extended stoppant, they make the move and reverse it. Whenever they make a reverse, quickly enter into the market, you will be able to see that money. Don't think that you have to necessarily do waiting for a long time or allow the market to settle. Then by the time the market would have gone up. Then table for position trade. Okay, I explained. John, pickpockets the same since 200 years ago. Yes, obviously anybody wanted to earn money by cheating other people, they have to be very cunning, and they have to first of all make the person to accept him as a friend. Then they will deceive. So that is what you come across in most of the time. Lot of freebies come through online and things like that in the internet arena. You find that later on it becomes a trap. So anybody who wanted to cheat you, first of all, they have to behave as if they are going to do enormous good for you. Then you have to discriminate it, including me. Whatever I talk, don't simply blindly follow it. You find the value in it and only pick up that particular information which is suitable for you. Don't trust just like that. If a person is talking to you in a very convincing way, then ash. Okay. I have been tracking these players for so many years and giving it in the blog. At times my reading might go wrong because sometimes the volume variation might come in the market, or then they can suddenly change their intentions. And accordingly, I just give the updates and things like that. And it is not that I only learn how to read the intentions of the players. I want everybody to learn, because whatever the helping hand I can give it, it can be for a limited period. But beyond that, the self-help is the best help for anybody. So a self-realization of this is very essential for the traders not to lose money. My main objective is the traders should not lose their hard-earned money in the market. So I am trying to do it as a mission in this process. Well, do you use charts or all the observations are done only using live market quote page? I use only the live market quote page nowadays for the past 10 years. And earlier I used all the type of charts and also all the sophisticated statistical analysis beyond what is available now ready-made. I used to do the calculations manually and did it. But I found there are a lot of limitations and finally ended up in looking at the live market quote page. And I was really finding it difficult to shift it from that of the chart reading to that of the live market quote page. Later on I find that it is really rewarding. Then now I started preaching people that you better follow only the live market quote page rather than the charts. Yeah, just I track the moves and also the amount of pips they make it by looking into that of the next changes. Then determine, okay, this is the move they are doing, next move what they are trying to do, I will be able to read it. I want you to read it. They have the trading strategies in the website. Yeah, I have the trading. Next webinar will be about that. Don't worry, I will exhaust everything for you to make it as a good trader. Then these net changes since what time? For a pretty long time. So before 1999, they used to make about 300 to 400 pips swings in CHF in one day. That was considered as a virulent currency in 1997, 98 and all. And subsequently they have regulated it and they are not making such moves. Now you find the GBP has taken that particular seat. And even there, they used to make about 250 pips swing. And there are so many days they had done 250 pips on the downside, 250 pips on the upside also. And nowadays that sort of moves are not seen in the market. In chariot. GBP raised for 4 days against the hat-trick rule. If you look at the chart, you can say that the same consolidation. See, that is what you look into it. When they are making a higher level consolidation, they will make an upward stop. The upward stop, and you think that it is a continuous rise. So, if they continue to rise it, then you can say that it is an upward move. They just sporadically make extended upward stop sometimes. So you have to differentiate the type of moves, please. Okay, these are all the questions. So I'll try to wind up the webinar. So I'll just focus on the last slide. Okay. So I take this opportunity to thank FX Street and the participants who have come here to listen to my talk. And we'll meet again next week on 2nd of August between 10 and 10:45 GMT. I'll be giving the 7th basic trading strategy. So many have asked about it. How to decide on the entry, stop and exit simply using the live market quote page. Nothing more than that. And we can really do effective trading. So see you again, and tomorrow I'll come back during the Asian session live market analysis. Till such time, goodbye.